Welcome back, everyone. The 4-factor dividend growth portfolio is my own version of SCHD, except it's tailored to my preference for quality companies with the focus on the growth part of dividend growth. After 8 months, this portfolio has a return of 19.88%, and thus far it's doing better than SCHD and the S&P 500. If you want to know more about how I built this portfolio, I'll leave a link in the description below to the original episode. Today, I want to run through all of the individual holdings, talk about some of the observations I made since this portfolio was launched, and some of the changes that I will implement in November when the portfolio will be updated for fiscal year number 2. I have also started running the 4-factor screening process each month, and I'll tell you which stocks rank the best as of month-end June. Let's dive right in. June was a very good month. The portfolio posted a solid gain of 5%, making June the third best month since the portfolio was launched. Since inception, which was November 1st, 2022, the portfolio is up almost 20%, 19.88% exactly, which is a pretty strong 8-month return. The S&P 500 is up 16.32% since November 1st, which means my portfolio is doing 3.62% better. While this lead was higher a few months ago, it's still nice to be sitting ahead of the S&P 500. Although beating the index is not necessarily the primary objective, what I want this strategy to achieve is a strong long-term rate of return of at least 12% annually. I also want the portfolio to provide consistent and above-average dividend growth. I'll provide an update a little later on the actual dividend growth in this portfolio. The portfolio was launched with 30 member stocks and a unique allocation that was based on float-adjusted market caps. Because of this, all of the stocks make up different weights, and one thing I have been looking at since this portfolio was launched is what the equal weighted return would have been. For the month of June, the average return for all 30 member stocks was 6.58%, or 1.58% better than the actual portfolio return. This means that now there have been 4 months where the equal weighted allocation outperformed the actual portfolio, and 4 months where it didn't, a nice and even split. However, when you combine the monthly returns, the equal weighted allocation is performing better, but more on that later. Let's now dive into each individual position and see how it performed in June and since November. Up first, we have ASML Holdings that rose by 0.25% in June, a rather flat showing. Since November, the stock is up 54.68%, making it the 6th best performing stock in this portfolio. ASML started with a large weight of 6.67%, so its return plays a rather important role for the portfolio as a whole, and it has been one of the primary drivers of the solid performance I have seen thus far. Up next, we have AbbVie that fell by 2.34% in June, and this makes it now 3 consecutive months of red returns for this healthcare giant. AbbVie is also in the red since November with a loss of 6.23%, making it one of the worst components of this portfolio. It also started with an initial weight of 6.67%, and as such, its poor return is having a substantial impact on the overall return. Number 3 is Taiwan Semiconductor that posted a below average gain of 2.8% in June, but is up 66.47% since November. TSM is actually the best performing stock in the portfolio, but there are a few other stocks that are pretty close to taking this title away. TSM also started with a 6.67% allocation, and along with ASML accounts for nearly half of the portfolio's return. Number 4 is Home Depot that posted a strong 9.59% gain in June, which was enough to push its return since November back into the green. The stock is up 7.06% since portfolio launch, which is below par compared to the portfolio as a whole. Home Depot also started with a 6.67% weight. Number 5 is MasterCard that finished June with a solid gain of 7.75% and is up 20.23% since November, a respectable performance track record thus far. MasterCard also started with a weight of 6.67%, making it one of the core positions in the portfolio. Number 6 is Visa that posted a good 7.44% gain in June and is up 15.35% since November. Not quite as good as its main rival MasterCard, and also below the portfolio return as a whole. Visa also started with a 6.67% weight, and since its total return is lower than the portfolio's return, it has been a little bit of a drag on the portfolio. Rounding out the top holdings with a starting weight of 6.67% is Merck, that finished June with a 5.21% gain and is up 16.31% since November. The top 7 largest stocks make up nearly 47% of this portfolio, and their returns are key drivers of how the portfolio performs. Thus far, it's really just ASML and TSM that have carried this entire portfolio, which is making me question using the float-adjusted market cap in the future to set portfolio weights. Let me run through the remaining 23 stocks. Number 8 is Cisco that gained 4.17% in June and is up 15.67% since November. Cisco started with a weight of 6.61%. Number 9 is Accenture that came in below par in June with a gain of just 0.87% and is up 9.55% since November. Accenture started with a weight of 6.35%. Number 10 is Texas Instruments that posted a below average gain of 3.53% in June and is up 13.72% since November. Texas Instruments started with a weight of 5.17%. Number 11 is UPS that gained 7.34% in June and is up 9.78% since November. UPS started with a weight of 4.34%. Number 12 is Lowe's that posted the third best return in June of 12.22% and is up 16.96% since November. Lowe's started out with a weight of 4.3%. Number 13 is Lockheed Martin that finished June with a gain of 3.69%, but is still down 3.56% since November. Lockheed started with a weight of 3.86%. Number 14 is ADP that posted a decent gain of 5.78% in June, but is down 7.56% since November, making it the second worst stock overall. ADP started out with a weight of 3.56%. Number 15 is BlackRock that gained 5.88% in June and is up 9.32% since November. BlackRock's initial weight was 3.24%. Number 16 is Applied Materials that put up a solid gain of 8.43% in June and is up 64.93% since November, making it the second best overall stock, just barely behind TSM. Applied Materials started out with a weight of 2.69%, which means its 64% gain hasn't had as large of an impact on the portfolio as TSM. Matter of fact, Applied Materials' contribution to the portfolio return is a little bit better than MasterCard's, that is up only about 20% since November. Clearly, a larger allocation here would have been beneficial, but hindsight is always 20/20. Number 17 is Infosys that posted a modest gain of 2.04% in June and is down 13.04% since November, making it the worst stock in the portfolio. Infosys started out with a weight of 2.45%. Number 18 is Lam Research that finished June with a gain of 4.53% and is up 60.4% since November, making it the fourth best overall stock. Lam Research started out with a weight of 1.96%. Number 19 is KLA Corporation that had a solid gain of 9.49% in June and is up a very nice 54.85% since November. KLA started out with a weight of 1.59%. Number 20 is Paychex that finished June with a good gain of 6.61%, but is still down 3.37% since November. Paychex started out with a weight of 1.35%. The top 20 stocks make up about 94% of the portfolio weight, meaning that the bottom 10 stocks are pretty insignificant, which is another reason why I'm thinking whether the weighting approach I used may not be optimal. Stock number 21 is Fastenal that posted a very good 9.55% gain in June and is up 23.73% since November. Number 22 is T. Rowe Price Group that finished June with a gain of 5.68% and is up 9.05% since November. Number 23 is Ferguson plc that was up 9.09% in June and is up 46.4% since November. Number 24 is Expeditors International of Washington that finished June with a gain of 9.81% and is up 25.29% since November. Number 25 is Monolithic Power Systems that rocked a cool 10.48% return in June and is up an even cooler 60.48% since November, making it the fourth portfolio stock to be up more than 60% during the last 8 months. Number 26 is Best Buy that had a fantastic gain of 14.12% in June and is up 24.02% since November. Number 27 is Skyworks Solutions with a gain of 6.94% in June and 31.05% since November. Number 28 is Snap-on with the best return in June of 15.8%, and it is up 32.36% since November. Number 29 is Garmin with a below average return in June of just 1.8%, and a decent return since November of 21.08%. And last but not least, we have Rollins that posted a strong gain of 8.93% in June and brought its long-term return into the positive range. Since November, the stock is up 2.81%. You may have noticed that the bottom 10 stocks with the smallest weights are actually doing quite well since November. Unfortunately, their low weight in the portfolio isn't turning their strong results into much of a gain for the portfolio as a whole. Out of the 19.88% year-to-date return for the portfolio, the bottom 10 stocks have only contributed 1.62%. It's useful to look at this data from month to month, as it helps me think about the changes I can make to this strategy in the future that could lead to even better results. I've already alluded to the fact that an equal weight allocation would have performed better than the allocation I opted to use instead. An equal weight allocation would have also been simpler to implement. Another drawback of using the float-adjusted market cap weighting system was that the initial ranking of these top 30 stocks played no role in their exposure in the portfolio. I have been tracking the individual returns based on the position that each stock had in the original ranking process. The average return for all 30 stocks is 22.58%. The top 15 ranked stocks have an average return of 27.48%, while the bottom 15 ranked stocks have an average return of only 17.68%. Not all of the top ranked stocks have performed well, but on average, more of the better performance were amongst the higher ranking stocks. This could point to the fact that perhaps including 30 stocks may have been too many, and the portfolio would be better off if it was more concentrated towards just the top 15 or 20 stocks instead. Another benefit that a more concentrated portfolio would provide would be a better starting dividend yield. I don't recall the initial starting dividend yield, but it was somewhere in the range of 2.3%. The top 15 ranked stocks with an equal weight would have started with a yield of 2.71%, and the top 20 would have had a yield of 2.61%. A yield of 0.3 or 0.4 is not that much higher, but it could generate a substantially larger dividend stream depending on the market value of this portfolio. Thus far, 16 out of these 30 stocks have increased their dividend rate. The average increase is a very nice 15.08%. Factoring in the actual weights of each stock and including the 14 stocks that have yet to raise their dividend, the dividend growth rate stands at 8.22% right now. That's still a very respectable growth rate that will highly likely climb before the first fiscal year ends in October. While I still want to review the equal weight and more concentrated portfolio options, as of right now, I will highly likely change this strategy when it comes time to rebalance the portfolio. I am leaning towards including only the top 20 stocks with an equal weight allocation. Another option I am considering is rebalancing the portfolio at each month end. Since I am testing this portfolio in a traditional IRA, there are no tax consequences of doing this. I ran a test of how this would have worked out had I implemented this strategy in November, and it would have led to a total return of 25.16%, or more than 5% better compared to the actual portfolio return. I completely understand that this same pattern may not repeat again next year, and I can't simply find the best combination of what would have worked this year and expect it to continue working in the future. But these changes make logical sense, and it would be a much simpler portfolio to implement and track. As I mentioned in the beginning, let me wrap up here with the top 30 stocks selected by this strategy at month-end June. Some of the original stocks are still amongst this bunch, but there are a handful of new companies that have popped up or moved higher on the list. I started sharing this list with my Patreon members each month, so if that is interesting to you, you can check it out using the link in the description below. I also share a handful of other spreadsheets and analysis there. Okay, stock number 1 is Sociedad Química y Minera de Chile, ticker symbol SQM. Number 2 is EOG Resources, ticker symbol EOG. Number 3 is Infosys, ticker symbol INFY. Number 4 is Williams-Sonoma, ticker symbol WSM. Number 5 is Cohen & Steers, ticker symbol CNS. Number 6 is Texas Instruments, ticker symbol TXN. Number 7 is ADP, ticker symbol ADP. Number 8 is ASML Holdings, ticker symbol ASML. Number 9 is Robert Half International, ticker symbol RHI. Number 10 is Fastnell, ticker symbol FAST. Number 11 is Paychex, ticker symbol PAYX. Number 12 is Home Depot, ticker symbol HD. Number 13 is Monolithic Power Systems, ticker symbol MPWR. Number 14 is Watsco, ticker symbol WSO. Number 15 is Lam Research, ticker symbol LRCX. Number 16 is Landstar, ticker symbol LSTR. Number 17 is Masco, ticker symbol MAS. Number 18 is Broadcom, ticker symbol AVGO. Number 19 is Rollins, ticker symbol ROL. Number 20 is Applied Materials, ticker symbol AMAT. Number 21 is UPS, ticker symbol UPS. Number 22 is Accenture, ticker symbol ACN. Number 23 is KLA Corporation, ticker symbol KLAC. Number 24 is Lowe's, ticker symbol LOW. Number 25 is Visa, ticker symbol V. Number 26 is MasterCard, ticker symbol MA. Number 27 is Tractor Supply, ticker symbol TSCO. Number 28 is Skyworks Solutions, ticker symbol SWKS. Number 29 is Market Access Holdings, ticker symbol MKTX. And number 30 is Novo Nordisk, ticker symbol NVO. I started tracking and documenting this list on a monthly basis to mainly accumulate this data, and in the future, I plan on testing if rebalancing more frequently than once per year can lead to better long-term results. The 4-factor stock selection strategy is meant to identify stocks that present an interesting investment opportunity today, so perhaps holding them for a whole year is not as beneficial as shifting to more opportune ideas more frequently. I think it'll be interesting to see that analysis, but we will have to wait until I collect enough data. I hope you enjoyed the video. If you did, please do me a huge favor and hit that thumbs up button to help me grow this channel and push the content to more people. And make sure to subscribe to the channel so you don't miss future updates. Thank you for watching and see you next time.